First of all, we would like to thank Dr. Noriza for giving us this golden opportunity to share about global financial issues, which is financial instability in the post-COVID-19. Our group members, Intan, Shafirah, Hanisah and Imanina.
Assalamualaikum and hi, my name is Intan Zulaika and I will start with the introduction. The COVID-19 pandemic, which affects the world globally, has changed the economic climate in several nations, including Malaysia. Not only has the pandemic increased the mortality rates globally, but it has also contributed to other issues, such as economic instability, rising unemployment rates, political unrest, the closing of small enterprises, and many more. According to Olivia Blanchard in 2020, he believes that there is a possibility of inflation to happen in the future. However, the rate of it to happen is low. He claims that even though the unemployment rate has gone up, it will go down once the COVID-19 lockdown is lifted due to high vacancies. According to the article, there are three things that will cause the inflation to happen, which is first, a very significant growth in the debt to GDP ratio, second, a very large increase in the natural rate of interest, and third, the dominance of fiscal policy in monetary policy. In May 2022, the Minister of Finance, Tengku Zafrul Aziz, however, says that the inflation is one of the things that causes the economic growth to slow down. This is due to first, the war between Russia and Ukraine, and second, the disruption of supply chain due to the COVID-19 lockdowns in China. Therefore, in order to control inflation so that it remains at a low rate, the government has implemented several measures including controlling the price of goods, especially the controlled goods, increasing the subsidies for goods such as food and fuel, providing help such as financial assistance for those who qualify, and many more.
Assalamualaikum everyone. My name is Shafirah Binti Mamat. Now we proceed with the finance for the global financial issues, which is financial instability in the post-COVID-19. Post-COVID-19 financial system instability has surprised us recently. Nearly the whole nation is financially struggling, which has weakened the economy. Due to economic volatility, the value of money is dropping, and this scenario involves certain countries. According to the article, the COVID-19 scenario has worldwide consequences. It has affected several economies and made their problem worse, possibility causing a recession. This article examines how the global financial crisis and the COVID-19 outbreak influence the US economy. The current COVID-19 outbreak hurts the economy more than the global financial crisis. The job market also reflects the recovery's progress. Before the epidemic, unemployment was 3.3%. In Q2 2020, it was 5.1%. By 2022, this rate has dropped to 4.1 until 4.2%. Even if the number of jobless in this age bracket has gone down in the previous 2 years, they remain the largest group. The poor employment market caused median income to fall 15%. The number of jobs only increased in the fourth quarter of 2021. Malaysia's financial instability during post-COVID-19 epidemic caused inflation. Malaysia's largest challenges are geopolitical concerns and supply chain difficulties in China. The first 2 quarters of the year have been good for Malaysia's economy, and unemployment is falling. It's predicted rising inflation and Malaysia's energy costs will climb. Prices went up because of geopolitical uncertainty, problems with the supply chain, and COVID lockdowns in China, which is one of Malaysia's main trading partners. Since Russia attacked Ukraine, energy prices have gone up, and Chinese regulations on COVID have made it harder to get energy to places that need it.
Hi, Assalamualaikum. My name is Imanina and would like to present about the current recommendation about this topic. The first one recommendation is
that can be implemented by the government to overcome this situation is by the imposing price control. The phrase price control refers to the setting of maximum and minimum prices for a set of imported items. So normally the government will apply the maximum price when this situation occurs. So as the price of oil increased by 58 cent this year and made the current oil price of RM1.95, the government has agreed to set the ceiling price for RM1.95 petrol at RM2.05 and RM2.50 per litre for this year. Ministry of Finance stated that implementation that this ceiling price is intended to protect consumers from the effects of significant oil price in the global market that increased sharply due to high in global crude oil demand, which was affected by the reopening of various economic sectors around the world. Other than oil, there are also another items that government has imposed ceiling price instantly during Covid-19 pandemic. For example, is the live chicken wholesale price is RM9 per kilogram, grade A chicken eggs at 34 cents per unit, and local beef at RM32 per kilogram, and mackerel fish at RM30 for 7 to 8 units per kilogram. This is to ensure that no irresponsible parties will take the advantage to set a higher price on essential items during movement control order (MCO). The second recommendation that can be implemented is by Bank Negara in order to overcome this situation. So according to the article, by following the Monetary Policy Committee (MPC) meeting, Bank Negara keep the overnight policy rate OPR at 1.75%, which was expected by the market. Furthermore, the economists also agree that the current interest rate is sufficient to accommodate the economy. The OPR is likely to be maintained at 1.75% despite the increased uncertainty caused by the pandemic and supply chain disruptions, as well as the delay in the economy's reopening. The key benchmark interest rate is unlikely to be raised this year, but more likely next year despite the downside risk to growth. Lastly, it is also been stated in the article that the central bank is expected to keep its monetary policy loose since the economy is operating below potential. Last recommendation is policies to reduce costs, push inflation are essentially the same as policies to reduce demand pull inflation, and the government can change tax and spending levels in order to influence the level aggregate of demand. To reduce the inflationary pressures, the government can increase tax and reduce government spending. This will reduce the aggregate demand, and the government could pursue deflationary fiscal policy, higher taxes, lower spending, or monetary authorities could increase interest rate. So this will increase the cost of borrowing and reduce the consumer spending and investment. The problem with using higher interest rates is that although it will reduce inflation, it could lead to a big fall in GDP. So the government needs to ensure that revenue is able to meet operating expenditure, and hence that a surplus in the current account is maintained at all times, ensuring the availability of domestic and external financing without crowding out the private sector, and ensuring that debt servicing does not exceed 20% of total operating expenditure. These are to ensure the public debt remains at a manageable level.
Generally, inflation is caused by the fall in aggregate supply to equal the increase in aggregate demand. It can be controlled by increasing the supplies of goods and services and reducing money incomes in order to control aggregate demand. High inflations may cause negative impact to a particular country. All in all, Malaysia's expectation for a more robust economic rebound in 2022 have been affected by various of risks. The shift to the COVID-19 endemic phase will likely boost domestic economy activity. Nevertheless, the economic gains from increased mobility may be less than anticipated. A slow labor market and domestic spending could harm the country growth prospect. Despite increasing market pricing for some of the country products, a slowing global economy and inflationary shocks will have a negative influence on the country growth domestic product. Inflationary shocks could be worsened if the Federal Reserve raises interest rates more to combat domestic inflations
in the United States.